3 consecutive years. Central banks around the world quietly purchasing over 1,000 tons of gold annually, the highest level since 1967. Not since the collapse of Bretton Woods has the world seen institutional gold buying at this scale. The People's Bank of China alone increased its gold reserves for 18 consecutive months. Poland doubled its holdings. Turkey accumulated aggressively. India expanded reserves quarter after quarter. And while these institutions were accumulating gold at record pace, what were they telling the public? That fiat currencies are stable, that the dollar is strong, that gold is a relic of the past. Now, you might think central banks are just diversifying. Routine portfolio management. Nothing to see here, right? Wrong. When the institutions responsible for managing national wealth consistently buy an asset for 3 years straight, they're not diversifying. They're preparing. They know something. And according to data from goldandsilver.com, we're witnessing the early stages of a precious metals explosion, not a market peak. There are 7 specific catalysts converging right now. 7 reasons why gold and silver could erupt from current levels. And by the time you understand all 7, you will see exactly why the smart money has been positioning while the mainstream media tells you to look elsewhere. Precious metals don't move randomly. They respond to a specific set of conditions that have repeated throughout financial history. When central banks accumulate aggressively, prices rise. When real interest rates turn negative, prices rise. When industrial demand exceeds supply, prices rise. When geopolitical tensions escalate, prices rise. When currencies debase, prices rise. Each catalyst alone moves the needle. But when multiple catalysts converge simultaneously, that's when you get the explosive moves. The 1970s, the 2008 to 2011 run, the 2020 breakout. And right now, in 2026, we don't have 1 or 2 catalysts present. We have all 7 firing at once. Let me show you each one with data, with historical proof, and with the numbers that explain why what happened in 2025, gold up 67%, silver up 147%, might just be the opening chapter of something much larger. Let's start with the most significant signal, the one that should make every investor pay attention. Central banks purchased over 1,000 tons of gold in 2022, over 1,000 tons in 2023, over 1,000 tons in 2024, 3 consecutive years of buying at levels not seen since 1967. Think about what this means. These aren't retail investors chasing momentum. These aren't hedge funds speculating on price movements. These are the institutions responsible for managing national monetary reserves, the people who literally print the currencies we use. And they're exchanging those currencies for gold at record pace. China led the charge. The People's Bank of China increased gold reserves for 18 consecutive months through May 2024. That's a year and a half of continuous buying. No pauses, no hesitation. Poland has been accumulating aggressively. Turkey has been a consistent buyer. India continues expanding holdings despite already being one of the largest gold consumers in the world. But here's the question nobody in mainstream finance wants to answer. Why? Why would the institutions that benefit most from fiat currency stability be buying an asset that competes with fiat currencies? The answer is obvious once you see it. They're diversifying away from dollar-denominated assets. They're hedging against what they see coming. They're positioning before the next phase of monetary instability. When central banks act, individual investors should pay attention. These institutions don't buy assets at record levels for 3 consecutive years without reason. They know something, and their actions are screaming it louder than their words ever will. The second catalyst is mathematical. It's the single most reliable predictor of gold price movements in modern financial history. Real yields, interest rates adjusted for inflation. Here's how it works. When you buy a treasury bond yielding 4%, but inflation is running at 5%, you're losing purchasing power. Your real yield is negative 1%. You're paying for the privilege of lending money to the government. In that environment, gold becomes extremely attractive. Gold doesn't pay interest. But gold also doesn't lose value when currencies debase. The opportunity cost of holding gold disappears when real yields are negative or near zero. And right now, that's exactly where we are. Current monetary policy has central banks trapped. They need to control inflation, but they also need to support economic growth and employment. This balancing act typically results in interest rates that fail to keep pace with actual inflation. 10-year Treasury yields minus inflation have hovered near zero or below. This compression creates the exact environment where gold historically thrives. Look at the data from previous cycles. 1970s. Real yields deeply negative. Gold exploded from $35 to $850. 2008 to 2011, real yields turned negative. Gold surged from $700 to $920. 2019 to 2020, real yields compressed. Gold broke to new all-time highs above $2,000. The pattern is consistent. When real yields fall, gold rises. When real yields stay compressed for extended periods, gold doesn't just rise, it explodes. Current conditions suggest real yields will stay compressed for the foreseeable future. Catalyst 2 is firmly in place. Now let's talk about silver, because what happened in 2025 validated everything investors need to understand about silver's unique characteristics. The gold to silver ratio measures how many ounces of silver equal 1 ounce of gold. In April 2025, this ratio sat above 100.1. Silver was historically cheap relative to gold. What happened next was textbook. Silver delivered exactly the kind of explosive catch-up rally that occurs when the ratio reaches extremes. Prices surged from around $30 to over $78 per ounce, a 147% gain. Silver didn't just outperform gold, it dramatically outperformed, validating the thesis that silver offers higher leverage during precious metals rallies. The ratio is now compressed to approximately 57.1, still below the decade-long average of 70.1, and historical patterns suggest it could compress further. In the 2011 peak, the ratio reached 31.1. But here's what investors need to understand about silver. The same leverage that drives 147% gains can produce equally sharp corrections. Silver's volatility cuts both ways. This isn't a criticism, it's a characteristic that must be respected and managed. Bull markets and precious metals often unfold in multiple legs. The 2010 to 2011 rally saw silver climb from $17 to $49 over 11 months. But along the way, there were several 15 to 20% pullbacks. Each pullback shook out weak hands. Each recovery reached new highs. If current fundamentals remain supportive, 2025's gains could be the first chapter rather than the final page. But managing risk after such significant moves is crucial. Catalyst 3, silver's leverage, is fully activated. The fourth catalyst is unique to silver, and it's creating a supply-demand imbalance that cannot be ignored. Unlike gold, which serves primarily as a store of value, silver plays a dual role. It's both a monetary metal and an industrial metal, and the industrial demand side is experiencing a transformation. The green energy transition is a game changer. Each solar panel requires approximately 20 grams of silver. The world installed hundreds of gigawatts of solar capacity last year alone. That's hundreds of millions of ounces of silver consumed. Electric vehicles use 25 to 50 grams of silver per car. EVs require silver for electronics, charging infrastructure, and battery connections. As EV adoption accelerates, so does silver demand. 5G networks require silver, medical devices require silver, consumer electronics require silver, all because of silver's unmatched electrical conductivity. Now look at the numbers from the Silver Institute. Industrial demand is projected to reach approximately 700 million ounces this year. In 2020, it was around 530 million ounces. That's a 32% increase in just 4 years. And the trajectory shows no signs of slowing. Here's the crucial point. Industrial consumption removes silver from the market permanently. Unlike investment demand, which can return when investors sell, silver used in solar panels and electronics is gone forever. It's not coming back. Annual mine production sits around 850 million ounces. Total demand, industrial plus investment, approaches 1.1 billion ounces. The deficit is filled by recycling and above-ground stocks. But that's not sustainable long-term. When demand consistently exceeds production, prices must eventually adjust. The supply squeeze is real. Catalyst 4 is building pressure. Global uncertainty has reached levels not seen since the Cold War, and precious metals thrive in uncertainty. The logic is straightforward. Gold and silver maintain value regardless of political outcomes. They can't be sanctioned. They can't be frozen. They can't be devalued by government decree. Recent history validates this safe haven role. February 2022, Russia invades Ukraine. Gold jumps from $1,900 to over $2,050 in weeks. October 2023, the Israeli-Hamas conflict escalates. Gold spikes on safe haven flows. 2018 to 2019, U.S.-China trade tensions intensify. Gold breaks above $1,500 after years of consolidation. The current geopolitical landscape includes strained international relations across multiple regions, concerns about the stability of global institutions, the fracturing of the post-World War II order. These tensions show no signs of abating. As long as uncertainty persists, safe haven demand supports precious metals prices. Catalyst 5 is embedded in the global environment. The sixth catalyst is the elephant in the room, the one that governments don't want discussed openly: currency devaluation. The numbers are staggering. U.S. federal debt now exceeds $38 trillion. That's more than 120% of GDP. And it's growing every year. The U.S. isn't alone. Japan's debt-to-GDP ratio sits above 260%. European nations carry massive obligations. Emerging markets face their own debt challenges. These are levels historically associated with currency crises or dramatic devaluations. When debt becomes too large relative to economic output, governments face limited options. They can default, politically impossible in most cases. They can raise taxes dramatically, also politically difficult. Or they can inflate the debt away by debasing the currency. History shows which option they typically choose. When confidence in fiat currencies erodes, investors naturally turn to precious metals. Gold and silver have maintained purchasing power across centuries and civilizations. Think about this. An ounce of gold bought a fine suit in Roman times. An ounce of gold buys a fine suit today. Over 2,000 years, through the rise and fall of empires, through countless currency collapses, gold maintained its purchasing power. The unprecedented fiscal and monetary responses to recent economic challenges, from the 2008 financial crisis through COVID-19, expanded money supplies globally. These policies prevented immediate crises, but they also planted seeds of concern about future currency valuations. Precious metals serve as insurance against this monetary uncertainty. As currency concerns intensify, their value increases proportionally. Catalyst 6 grows stronger with every trillion added to national debts. The seventh catalyst is visible on the charts, and 2025 delivered exactly the kind of explosive move that technical patterns suggested was building. Gold surged 67% in 2025, from around $2,950 to over $4,400 per ounce. That's not a modest gain. That's the kind of move that defines bull markets. Silver climbed an even more impressive 147%, from $30 to over $78, validating everything we know about silver as leverage during precious metals rallies. These aren't speculative spikes. Volume patterns during this rally indicate institutional participation, not just retail speculation. Pullbacks have been met with buying rather than selling, a bullish sign. Gold is now establishing new support zones around $4,200 to $40,400. The market is digesting gains rather than reversing them. Silver has broken above resistance levels that contained prices for over a decade. The charts show price discovery zones with limited historical resistance overhead. When assets break into new all-time high territory, there are no previous sellers waiting to exit at break-even. The path of least resistance is higher. Historical precedent from the 2010 to 2011 rally offers perspective. Gold gained 80% over 18 months with several corrections along the way. Silver more than tripled during the same period. If current fundamentals remain supportive, 2025's gains could indeed be the first chapter rather than the final page. Catalyst 7, the technical breakout, has already occurred. The question now is whether it continues. So what do you do with this information? You understand that 7 catalysts are converging simultaneously. Central bank demand, favorable real yields, silver's leverage, industrial supply squeeze, geopolitical uncertainty, currency devaluation concerns, technical breakout confirmation. This convergence is rare. It doesn't happen every year. When it does happen, precious metals deliver significant returns. You understand that positioning matters more than perfection. Timing exact bottoms and tops is impossible, but recognizing when conditions favor precious metals, appreciation is achievable. You understand that dollar cost averaging into positions manages risk while building exposure. This approach smooths volatility and prevents the regret of poorly timed lump sum purchases. You understand that gold offers stability while silver offers leverage. Conservative investors might emphasize gold. Those with higher risk tolerance might emphasize silver. The right allocation depends on individual circumstances. You understand that taking profits, managing position sizes, and respecting volatility are essential. Bull markets reward patience, but they also punish complacency. You understand that the source of this analysis, goldandsilver.com, provides ongoing updates as these catalysts develop. Staying informed is part of staying positioned. And you understand that by the time mainstream media confirms the precious metals bull market, most of the opportunity will have passed. The institutions are already positioned. The central banks have been buying for 3 years. The question is whether individual investors will recognize the pattern in time. This is not prediction. This is pattern recognition supported by data. 7 catalysts converging. Central banks buying at levels not seen since 1967. Real yields compressed. Silver delivering 147% gains in a single year. Industrial demand creating structural deficits. Geopolitical tensions at Cold War levels. Currency debasement accelerating. Technical breakouts confirming the trend. The convergence is real. The data is from goldandsilver.com. The pattern is visible to anyone willing to look. While mainstream analysts debate whether precious metals are overvalued. While financial media focuses on other narratives. While retail investors chase different opportunities. The smart money has already decided. Central banks have already positioned. And the catalysts driving this move remain firmly in place. If you want to understand precious metals markets, if you want to see how these catalysts develop week by week, if you want analysis based on data rather than speculation, subscribe now, turn on notifications, because the story isn't over. 2020's gains may have been dramatic, But when 7 catalysts converge simultaneously, history suggests the move has further to run. The central banks know something. They've been buying for 3 years. The question is whether you're paying attention, and now you are.